In this module, we've been examining the individual tax formula, as well as the inclusions for income and the exclusions as deductions. In chapter 14, we laid out the foundation, and in chapters 10 and 17, we looked at some of the individual considerations that go into calculating income. In this video, we look at the tax consequences of different compensation requirements, including salary, including fringe benefits, and including retirement planning. Recall that the adjusted gross income is calculated by adding the income from all sources, deducting any exclusions or adjustments, deducting the standardized or itemized deduction as applicable, and finally, by deducting the qualified business deduction, if applicable, to arrive at our adjusted gross income or taxable income. In this particular video, we'll examine gross compensation that is received through earning of a salary or working as a contractor, as well as looking at some of the employment items that are deducted from gross income or excluded from gross income. In the second part of the video, we'll look at retirement planning and those specific exclusions. One consideration from the employer side is how they should classify the people doing work on their behalf. An employee is an individual who performs services for compensation and who works under the direction and the control of the employer. For any employee on the employer's payroll, the employer pays federal and state payroll taxes. The employer also withholds payroll tax from the employee's paycheck, as well as income tax for the employees. The employer is responsible for providing the IRS with a schedule of employee wages and withholdings on a W-2 form. Now, sometimes it's more advantageous for an employer to hire contractors or someone on a limited basis to do work for compensation. The contractor himself is in control over the quality of the work performed and the manner in which the services are performed. But the employer has some discretion in what work gets done. Any fees paid by an employer to a contractor are net of the FICA payroll taxes, as well as the contractor's payroll withholdings. The contracting firm, or the employer in this case, provides a schedule of the employee payments to the contract firm on a 1099 form. In Chapter 10, we considered the tax effect of being paid as an employee versus being paid as an independent contractor. But now let's look at the income effect for an employer and why an employer might want to hire a contractor instead of an employee. To simplify this, let's look at Central Perk. And let's assume that they're considering hiring Phoebe as a performer in residence. They can either pay her an annual salary of $65,000 or they can pay her as an independent contractor for $72,000. If Central Perk is incorporated and pays 21% corporate income tax, which option is better for the coffee shop? And by better, I mean minimizes after-tax costs. The problem tells us nothing about the fringe benefits, like health care, which we know is required under the Affordable Care Act, or other benefits. So we can only herein consider the federal income tax requirement as well as the federal payroll withholding requirements. So let's look first at the contracting aspect of it. Contractors' fees are deductible for tax purposes. If Central Perk hires Phoebe as a contractor, they can deduct the $72,000 from their net income, which means that this helps them to avoid 21% of tax on the transaction. This means that Central Perk is avoiding paying tax to the government of $15,120, which means that the after-tax cost of hiring Phoebe as a contractor is only $64,080. So now let's look at if Central Perk were to hire her as a full-time employee. Her salary is $65,000. And they have to pay her half of the payroll tax, which means that her line item deduction is $69,973. We then compute the tax savings, since this is fully deductible expenses, which means that the after-tax cost of hiring Phoebe as an employee is $14,695 in taxes avoided, which means that the after-tax cost of hiring Phoebe as an employee is $55,278. The company saves themselves around $8,500 by hiring Phoebe as an employee instead of as a contractor. This assumes that Phoebe doesn't receive any fringe benefits, which is likely untrue. So let's talk about the tax consequences of employee compensation. For an employee, the wage you receive between January 1st and December 31st comprises your salary and wages. You record them for a year, and the employer throughout the year makes deductions for payroll withholding as well as income tax withholding. If the withholding throughout the year is greater than the tax liability owed, the taxpayer receives a refund. If the withholding is less than the tax liability, the taxpayer owes additional taxes. For an employer, salary costs are generally deductible in the year of payment. With certain exceptions, employee wages and salaries are tax deductible. And we'll talk about this a little bit more in the final module, where we examine things from the employer's perspective. But for now, it's enough to know that to be deductible, salaries and wages must be business related, and they must be reasonable. And the IRS has different general standards for evaluating reasonableness in relation to business operations. A fringe benefit, or perk, of employment is any economic benefit that carries a monetary value, is received by an employee as additional compensation, even if the benefit does not result in additional cash received. With some limitations, these fringe benefits are not taxable income to the employee and are a deductible expense to the employer. This means that even though employee-provided health insurance prevents the employee from having to pay health care, they don't have to pay taxes on that value. Group term life insurance is not reported as income, provided that income or that benefit is less than 50 grand. Any group term life insurance benefits above this amount must be included in taxable income. And likewise, dependent care assistance programs or on-site daycare programs that are provided on behalf of the employee are not considered additional compensation, even though this prevents a cost avoidance for the employee. And likewise, for the employer, offering any such benefits are deductible, which means by providing these benefits to employees, they not only help to make happier employees and help to encourage employee retention, they also avoid paying taxes on the transaction. Now let's examine the tax benefit of some of these fringe or employment perks, starting with the life insurance. As we just discussed, life insurance has a dollar value limitation above which an individual must report taxable income. So, how much taxable income would Ross have to recognize if he elects for $40,000 worth of group life insurance coverage through the Natural History Museum? The answer is nada, because his $40,000 of elected coverage is less than the $50,000 exclusion under the tax code. So now, what if Ross, recognizing that he has two offspring who will need his support if he passes away, what if Ross elects for $275,000? Well, we know that he's taxed on the benefit above $50,000. So this would be $275,000 minus $50,000. So only the $225,000 is considered excess. The Treasury cost for life insurance is 43 cents per month per $1,000. So we multiply the 225,000 of excess times 43 cents times, make that look more like a cent, times 12 months. Ross's total taxable cost of the extra coverage is $1,161. Now let's examine another after-tax benefit that some employers provide to their employees: on-site daycare. If Rachel would have to pay $10,000 a year, which is realistically low, to enroll Emma in another daycare, what would Rachel have to earn in additional income to make it be the same equivalent pay? Since this $10,675 is after tax, we need to figure out what the equivalent amount would be before tax. And to do this, we divide the untaxed benefits by 1 minus 0.32 to figure out what portion of income before taxes would go towards such expenses. And the answer is $15,699. That is, Rachel would have to earn almost $16,000 extra before tax in order to receive the same benefit that her company is giving her for free. Another perk that many employers offer is the award of stock options. Stock options are great because they vest employees in the company's success, as well as avoid the cash outlay for employee payroll benefits. The tax treatment of these different stock options and stock benefits depends on the type of stock option and when the employee takes possession of the stocks. The amount of income recognized for equity-based compensation depends on when the income is recorded and the value of the stocks when it is recorded. And there are three primary types of equity-based compensation. The first, restricted stock, is transferred to the employee with severe limitations until the stock benefits vest. In such a case, the employee would receive the stock shares on a certain date, but they would be restricted from selling the shares until a subsequent date. If the employee left the company prior to that date, the shares would revert back to the organization. So when is the income recognized for restricted stock? The employee can recognize restricted stock as income when the stock vests. That is, when they take full possession of the stock and have the full rights to sell it. The stock is valued at the amount the stock is trading for at the time of vesting. However, the employee can, by filing a written election with the IRS, include the value of the restricted stock as income when the stock is awarded. Generally, since stock tends to appreciate in value, this means that the employee would recognize less stock at the time of award than they would at the time the stock vests. However, if the employee does have to forfeit the stock because they leave the company, they cannot deduct the recognized income in the future. Stock options are the right to purchase a corporate stock for a stated price for a limited period of time. If the stock options are below the fair market value and are exercised, the employee must report the excess of market value over start costs as income. So what does this mean? If the stock option price is below the current trading price, that means that it's recognized when the employee takes the option. However, if the option price is greater than the current trading price and the employee elects to buy stock, this constitutes a regular purchase of stock, and there's no additional income recognized for such a purchase. The stock's value is the trade price at time of purchase. And finally, incentive stock options are kind of a hybrid of the restricted stock and the stock option. The incentive stock option is a qualified stock option for federal income tax purposes. The individuals do not recognize the bargain element as income upon exercise. The tax basis is the employee's out-of-pocket cost, and any additional income recognized is recognized at the time of sale. So let's check our comprehension of the taxable value of stock options by looking at a restricted stock transaction. If Rachel didn't record the value of the shares at the time of the grants, what would be her basis in the stock, and what would be her gain or loss on the sale if she sold the stock immediately? So, if Rachel had taken advantage of the stock restriction, she could have acquired 4,000 shares of stock at $20, which would be a basis of $80,000. However, since Rachel didn't take possession of the shares until October 1st, she's paying her basis in the shares of stock after she takes possession of them is $115,000, and her immediate gain on the sale of stock is zero because she turns around and sells them at the price for which she acquired them. So now, let's look at the opposite scenario. If Rachel did elect to record the value of the shares at the time of the stock grant, what would be her basis? What would be her gain or loss on the stock if she sells the minute that she's eligible? Her basis, if she had taken basis of the stock, would be this $80,000. She would turn around and sell the shares for $115,000, which means that her gain on the sale is $35,000, which is taxable income. Now let's look at the opposite scenario, how Rachel would treat the receipt of a stock option on her taxes, assuming the stock price at time of purchase is $33.50 and her stock option is $22. How much income would Rachel recognize upon the stock award? At the time of the stock award, Rachel would recognize zero income because at the time, she hasn't taken option of the option. It's valueless to her right now because the selling price of the stock is less than her option amount. But how much income would she report upon redemption of the award? Rachel must report the bargain element, anything above that, as income. So, since the stock is selling for $33.50 per share, and her option is $22 per share, she must recognize $11.50 per share times 500 shares as her income. This would be an amount of, so the income she would receive upon redemption of the stock option is $5,750. The value of the bargain element. What is Rachel's basis in the shares? Is the total value of the stock purchased. In this case, $33.50 times 500, or $16,750. In this part of the chapter, we examined the tax treatment of different compensation items, including base salary, employee perks, and employee stock compensation. In the next part of this unit, we will examine the tax treatment of retirement compensation provided by employers, as well as other investment and retirement decisions.